Well, we're going to get rolling in here this week, and instead of talking about yields or the grain market specifically, we want to address this whole equity market breakdown on Monday and this situation with Evergrande. If you remember last Thursday on our daily advisory report we had down on our market spotlight that you should take a look at an article in the Wall Street Journal that was titled "China Property Curbs and Economic Tremors." And I am looking down. I do have some notes written down in here right now to help me go through. But in that article, there's a company called Evergrande, which was highlighted. Okay, and now all of a sudden we come in here this week, and on Monday, the whole thing is well, who is Evergrande? Okay, so what we want to do here today is try to spell out on what we believe is happening with the markets and the situation in China. Well, Evergrande is a large Chinese lender with estimated assets of around $355 billion. Okay, we're seeing reports that they got liabilities about $305 billion. And what they are, though, not only a lender, but they're one of the largest property developers in China, as they currently have about 1,300 projects going on in 280 different Chinese cities. Now, the big dilemma in here this week is Evergrande has a debt payment due on Thursday for about $83 million, and now the market is watching. Can they make this debt payment or not? That is a big concern in China. Now, what it boils down to in a general comment here in the U.S. is, now, is this going to be another Lehman Brothers situation? You got to remember Lehman Brothers was shut down in September of 2008. So now let's compare the two. Let's look at Lehman Brothers and let's look at Evergrande. Lehman Brothers, before they went down in September of 2008, they had $639 billion in assets with $619 billion in liabilities. Okay, so you can take a look at this right now, and you can see that Lehman Brothers is almost double the size of what Evergrande was. Now keep this in mind, when Lehman Brothers was shut down on September 15th of 2008, we had the Dow at 11,359. It bottomed out in March of 2009, just below 6,500. So the whole Lehman Brothers deal, that led to a major break in here in U.S. equity markets and part of the whole housing crisis. Again, we had listed below on what the situation with Evergrande is right now. Now, the debate in the markets is Evergrande, too big to fail? That was the same thing that we went through back in 2008. And what will the Chinese government do? Well, the one thing we need to keep in mind is China can be a lot like in the U.S., and their property values have been going higher and higher and higher, and we have seen some speculation going on. And what we're thinking about right now, though, is as we go back to 2017, we saw a quote from President Xi Jinping that he mentioned, houses are built to be inhabited, not for speculation. And then earlier this year, he confirmed houses are for living, not for speculation. Now that kind of, to us, leaves it up in the air on whether they let an Evergrande fail or if the Chinese government steps in to support. That is a big debate in here right now. If they let Evergrande fail, we could get these markets rolling lower. Now let's just take a look at a few of the outside markets in here right now. The first chart we have up here is a weekly S&P. That goes back to 2019. We just like to highlight in the middle here right now with the COVID pandemic in 2020 and how the market broke sharply. Then we've been on a pretty good uptrend since then. And now just last week and even this week, this market, the equity markets, is giving us a sign that a near-term high is in place. Now, one of the hottest markets in the U.S. right now is a natural gas market. And as you can see in front of us right now, you had natural gas prices just pushed to their highest level since 2014 when it traded above $6. Part of this was because of Hurricane Ida in the Gulf, and we have improved demand. And right now, too, I mean, you can see the current administration is not as favorable for energy production in the U.S. as what the previous administration was at. The other market that's been pretty good is the crude oil market. Okay, and we have the rally in here over the last year and a half, and crude oil trading above $70 a barrel. As you look back between 2015 and 2019, the crude oil market essentially traded in a $40 to a $75 range. If we go all the way back to 2008 when we had the Lehman Brothers issue and the housing crisis, you can see where crude oil dropped from $140 a barrel all the way down to $40 a barrel in less than a year's time. So if you want to be bullish and talk about inflation, you're looking at the energy markets. The next chart we want to show you is a monthly copper chart, okay? And copper prices this past spring ran to an all-time high. Now they're starting to pull back here a little bit right now. We believe the $4 area on copper needs to be watched. If that is taken out, we got to be concerned that the economy is beginning to shift lower. Again, on copper, look back to 2008. Look at the sharp break that we found in copper prices with the housing crisis that we had here in the U.S. A chart here that we've shown probably a dozen times over the last year is the lumber chart, okay, and how futures have rallied substantially. Now we've had this pullback. Again, the market went up too high. We got overproduction. We pulled back on demand. And right now we're looking at lumber prices sitting around 65% off of those spring highs. Okay, that to us right now is not an inflation-led market. We're seeing this market pull back. The chart we really want to show you here today are iron ore futures, and they're traded in Singapore, and this really reflects the Chinese demand. And as you can see by this chart, we've had iron ore futures lose 50% of their value in just the last 2 months. This chart in particular tells us that the building or the property issues with this Evergrande in China is for real, and that demand in China is beginning to pull back. Okay, if we had strong Chinese demand, you'd probably see iron ore futures in a steep uptrend. Now we just want to look here at a lifetime contract of the iron ore futures contract. And as you can see on the whole run up here in 2020 to 2021, we had iron ore go from $80 all the way above $220, an impressive rally which was demand led. Now over the last month alone, we've given back nearly the last year or two of gains. Now here are some final thoughts. Okay, I think you got to watch China in here, and we watch them from the ag market standpoint, but we need to watch them on a financial standpoint as well. A big rallying point in the ag markets have been talked about inflation, okay, and we're feeling inflation at the gas pump. Consumers are feeling inflation at the grocery store. Okay, the energy markets are still hot right now. Now, are they going to peak out and see some slower demand in here right now? That's one thing to watch out. So if we're looking at the energy markets, we're saying inflation is for real. On the other hand, if we look over at the metals markets, and we'd have a chart of silver up, but if you look at silver, or you look at copper, or now you specifically look at iron ore futures, you would have to say inflation is not an issue in here right now, as those markets have turned lower. How is this going to affect the ag markets? You know, that's a big debate in here right now. But our thinking is ag markets, just from a pure money flow standpoint, will struggle to attract interest, especially if we have these issues going on in the metals market or the equity markets. The last thing we really want to mention here today, and this is just getting back to our producers, is it's extremely important to remember that the rally last fall and into the winter months was a demand-led rally. U.S. grain was cheap on the world market. We had increasing world demand, specifically from China, as they came in here and bought a lot of our grain. Right now, as we're sitting in here, U.S. prices are competitive on the world market, but we're not cheap like what we were a year ago, and it just seems like new demand is a little bit slower than we had 1 year ago at this time. So those are some things we need to keep in mind as we look ahead. Again, we went a little off topic in here this week, not just focusing on the corn and beans, but again, we need to remember that there's many things to look at, and this is a global market that we need to keep a focus on. If you have any questions or concerns, feel free to give us a call or drop us an email. Have a great day and stay safe during harvest.